Now, this is retirement quick revision series. Before exam, how can you quickly revise all things relating to revision in short time? So there we are again like admission. Here we need to take care of ratio. We need to take care of goodwill. We need to take care of accumulated profit and loss. And then we have capital adjustment. So let's look at the first thing, which is ratio. Uh, in admission, a partner sacrifices. New ratio is there in both, but here someone gains. Someone is going, the others have to gain his share, they get his share. So old plus gain is equal to new. So gain is equal to new minus old share. You can do that. Over here, you have one typical thing, say A, B, C are sharing in the ratio of 3 is to 2 is to 1. So if B retires, new ratio, nothing else given, A and B will get in the ratio of 3 is to 1. This will be their new ratio also, this will be their gaining ratio also. But if it was given that he's giving equally to these two, so his share is 2 by 6. 1 by 6 comes here. 3 by 6 plus 1 by 6 become 4 by 6. And C gets 1 by 6 plus 1 by 6, 2 by 6. So 4 is to 2 means 2 is to 1 becomes new ratio. And 1 is to 1 becomes gaining ratio as they are getting it equally. So old plus new gain, old plus gain can give you the new ratio. If simply someone's retiring is given, we minus that. It could be given like that. Say they are sharing in the ratio of 3 is to 2 is to 1. He gives a share only to C. If he gives it only to C, C's share becomes 3. So 3 is to 3 equal is the ratio in this case. And gain is only by C. So that's about the calculation of new ratio and gaining ratio. Typical examples I have taken, which comes in the case of retirement of a partner. Now, what is the treatment of goodwill? How do we treat goodwill in the case of retirement of a partner? The treatment for goodwill would be very simple. Who is going? Retiring partner is going. Who is getting his share? Gaining. It could be both are gaining, it could be only C is gaining. So gaining partners capital account gets debited and retiring partners capital account gets credited. With what? Retiring partners share of goodwill. Give it to him his share of goodwill. He gets credited, but who gets debited? Who is giving this? Gaining partner. If C is gaining, C. If A and B are gaining equally, A and B. So the remaining partners who are gaining get debited with this. Only one treatment. If existing goodwill given in balance sheet, we will write it off old partners to goodwill entry in old ratio. Whatever is given gets divided. Then comes accumulated profit or loss. How do we treat accumulated profit or loss at the time of retirement of a partner? Accumulated profit losses, as we were discussing, belong to old partners in old ratio. This general reserve, contingency reserve, and P&L. These are your accumulated profit. Say ABC were sharing in the ratio of 5 is to 3 is to 2. A retires. This goes to ABC in the ratio of 5 is to 3 is to 2. Similarly, deferred revenue and investments, it is a opposite entry. So capital account to P&L to deferred revenue expenditure, of whom all three A, B, C, all three capital accounts in the ratio of 5 is to 3 is to 2. This gets debited to their capital account. We reduce their capital with this loss. Then, like previous chapter, now over here one term is given, employee provident fund. Employee provident fund is not an accumulated profit. Please remember, by default you all distribute it. This is your liability towards your employees. This is like any normal outsider's liability. You will not be transferring it to capital account. Now, workman compensation fund and investment fluctuation fund. How do we treat these? Again, we need to see the claim and accordingly transfer this. If in this case claim was 30,000, so what is the fund left with us? 10,000. So workman compensation fund gets debited with 40,000. Claim is 30,000. ABC get the remaining 10,000 in the ratio of 5 is to 3 is to 2. Old partners get it. What if the claim was 40? Only workman compensation fund debit, workman compensation claim credit, 40,000 gets transferred. But if it was 50,000, then reval comes into picture. Reval will not come into picture if we are not if we have not if we have provided well, it will not come into picture. If we have provided less, it comes into picture. So workman compensation fund debited 40,000, reval debited 10,000, and to workman compensation claim we have to give 50,000 rupees. Next, if investment fund is 12, investment is valued at 25,000. If market price of investment is 20,000, market price falls by 5,000. So out of this 12, 5 we have taken, 7 we can give to old partners in old ratio. If the market price is 30,000, so whole 12 goes to ABC, old partners, old ratio. Remaining 5 comes in reval credit side, the benefit which we are making. If investment market price remains same, whole 12 goes to these partners. If the investment market price is 5,000, one more example I take 5,000. So that means there's a decrease of 20,000. 8,000 extra loss will come in reval account. Then here again we need to prepare your reval account. Good and bad remains same as we were doing it earlier. Here also I suggest go through all adjustments and practice it. There are different wordings which are possible, so you need to know how these will be shown. Say creditors are undervalued by, creditors are undervalued by 2, so revaluation debit side 2000 problem will come. Creditors are increased by, same impact. These are some typical adjustments, simple ones which are discussed here. The next one is if creditors are now valued at 12. Again, this is a 2000 increase. So all three will have same treatment. And in new balance sheet, in all cases, creditors will be shown at 12,000 rupees. You are not tested for balance sheet, but still you need to know the treatment. It can be, it's a part of syllabus, but somehow because of marks they are not testing. We should not ignore balance sheet. They might give reval loss or gain to you and ask you the balance sheet treatment. So you must know what is the treatment in the balance sheet also. EPF was raised by 20%. 20 by 50%. EPF is 12, half of that is 6,000. So now EPF is valued at 18,000. So we are increasing our liability by 6,000. That's bad for us. So reval debit side 6,000 should come. Outstanding expenses were brought down to 1,500. There's a reduction in liability, good for us. Credit 500, only the difference. And in in new balance sheet, outstanding expense, as they have clarified, will come at 1,500 on liability side. Next, relating to provision. Provision for debtors to be maintained at 10%. So 10% of debtors 15,000 is 1,500. We have already a provision, like they have given it on liability side rather than deducting their 1,000 becomes 1,500. There's an increase of 500. There are different wordings possible for the same. In next case, they've told if provision is reduced by 500. So this 500 is coming on debit side, this 500 will come on credit side. It's good for us. If debtors are all good, provision is not required, we credit with the full amount of provision. In new balance sheet, provision doesn't come. Now, if FBD, further bad debt, is given, what is our debtors here? Debtors is 15. 15 minus 3, 12,000. 12,000 into 10%, 200. So we'll show 3,000 plus we will also show the extra 200 provision which we need to make. Now, stock to be raised by 3,000. Raised by means now valued at 15. So it's good for us. So reval credit side, we will show this difference of 3,000. Fixed asset, you look at which are the fixed asset. If they're using this word, there might be more than here. In this case, stock and machine both have to be depreciated. Unrecorded stationery is unrecorded asset. Outstanding expenses are brought down by 200. There it was now valued at 1500. This is brought down by. So down by, read the statement and understand it. Unexpired insurance is prepaid insurance, which is our asset. So these are the some simple typical adjustments which have been covered here to revise reval also, but uh, it's not restricted to these one. Must go through your illustrations, prepare as many reval accounts as possible because it's there for sure. So if you take 1 hour for all admission reval question and 1 hour for all retirement reval question, and you can make your list of different points, how each thing is treated, your chances of getting say 2 to 3 marks which are reserved for reval account are confirmed, and each mark matters. And if we are aiming at 100, a flawless reval is a blessing for us. Then let's come to capital adjustment. In capital adjustment, for this chapter, there are different possibilities. I take the adjusted capital of A and B as 36,000 and 44,000 respectively. There are three partners, say C is also there, let it be 20,000. Now over here, any of these could retire. I retire C in this case. First possibility, no capital adjustment, nothing given. Transfer C's balance to his loan account and pay it to C. Second possibility is C is to be paid. Sorry, C nothing information is given, but A and B to share future profits and losses equally. In future they want their capital to be equal. The new ratio of capital is equal. New partnership ratio is equal. So what they will do is they will adjust these two capitals. They will divide 80,000 equally 40,000 each. That's one possibility. Another possibility is it is told that capital of new firm to be fixed at 90,000. Certain amount will be given and they will be sharing it equally. So it becomes 45 and 45 as their new capital. When we are changing their capital, like here 36 becomes 40. So this person brings in 4,000. So either it would be in cash or it could be through current account. Also these adjustments could be made. In this case 44 becomes 45, this person will bring 1000. 36 becomes 45, that person will bring 9000. So one is new capital is given, or they want their capital to be new ratio, so take this adjusted capital, divide it. Last possibility after this is they want their adjusted capitals to be, they want to pay C and their new capitals to be in new ratio, and they'll bring in sufficient cash for that. There we take adjusted capital of all 3 and 4 7, 80,000, 1 lakh. So that's the new capital. If I divide it in new ratio 50,000 each, A's old capital was 36. A is making it 50. So A brings in 14,000. 44 becomes 50. He brings in 6,000. So total they are bringing in 20,000. And what do we need to pay A? 20,000 only. Let me share the same in the form of a worksheet with you. Over here, if we can see that we are given the adjusted capital of all. I'll just note it for you. So there are different cases which are given, all have been shown together. Sorry. Uh, so let's look at all cases one by one. You are given that ABC are sharing in the ratio of 3 is to 2 is to 1. This is common. B retires. Adjusted capital of A, B, and C. After giving reval, goodwill, everything, this is their capital. And they want their new ratio to be equal. These are the statements which can make the difference in capital adjustment. Capital of new partners was fixed at 90,000. B was to be paid 5,000 in cash, balance to be transferred to his loan account. Pass the journal entry for capital adjustment. Find out the amount of cash brought in or withdrawn by partner. New capital is this. So they are sharing it equally. So each one's capital is 45,000. A's capital 45, B's capital 45. What is their old capital? 50,000 and 40,000. What does this means? A wants it to be 45 only and it is 50. So he will withdraw 5,000. Whereas B's old is 40, it has to be 45. He has to bring in 5,000. What is the, this is a new ratio, this is a new capital. So what would be the entry? Cash to B, he's bringing in 5,000. And here A to cash because he is withdrawing 5,000. This is the withdrawal entry. Withdrawal from business of cash. And here the first one, he's bringing in cash. Next case, existing capital of remaining partners to be in new ratio. It's not 90. What is their existing capital? Capital of A is 50 and B is 40. So their existing capital is 90,000. They want to share it equally. Answer will come out to be the same. Here they had given capital. Here we took it. It could total could be something different also. By chance it is same. So 90 again same adjustments will be made. Third is they want to maintain it same as what was in their old balance sheet. They have given you old balance sheet. A, B, C, their capitals is 1 lakh. In new balance sheet, when B retires, A and C should also have capital of 1 lakh and that too in new ratio 1 is to 1. So their new capital becomes 50,000 each. Old we already know is 45 and 40. What, I'll just check the amounts. What are their old capitals? Old capitals are 50 and 40. So this person, there is no change. This person brings in 10,000. So new capital is 1 lakh. New ratio is 1 is to 1. Statement 4. They want to bring in sufficient capital to pay B and capital of the other to be in new profit sharing ratio. Here take adjusted capital of all A, B, C including retiring partner 50, 40 and the third one is 30,000. Okay, here B retires. So sorry, there is a correction. This should be 30,000. He brings in 15,000. So accordingly, the change would be made in all. So here the capital would be 50 and 40, 90 plus 30, 120. So total capital of new firm becomes 120, which they divide in new ratio of 1 is to 1. So new capital is 60,000 each. Old capital of A is 50 and C is 30,000. B is 30,000. C, it should be C, not B. 50,000 and 30,000. So this person brings in 10,000. This person brings in 30,000. Total amount 40,000 brought in, and that is our B's capital. We need to pay B 40,000 only. Last statement under this is, which is same as statement 4, but here you want to maintain certain cash balance. The old balance sheet has cash of 15,000 and they say even if we have it 5,000 it is okay. So that means firm has 10,000 rupees to pay to this person who's retiring. We take adjusted capital as 120 only minus available cash 10. So new capital becomes 1 lakh 10,000. I repeat, take adjusted of all minus the available cash by firm, and then you will get the new capital, divide it in new ratio, compare it to old capital. So this is an accounting treatment of capital adjustment. This type of cases can come as MCQ also. This could be a part of long question also. And if we see the present year paper, they have not given any capital adjustment. So it's not a must that it would be there. They've given more reval related adjustment. And instead they have told that the retiring partner is given a certain amount, say 20,000, which is brought in by old partners in a particular ratio. So simple adjustment goes into their capital cash they are bringing in, and this cash is paid to the retiring partner. Otherwise no other capital adjustment was there in that question. So it's not must every question would have it. Read the question carefully and determine it. Thank you.